Larry, great to have you on board with us. And we mentioned the strength of the US dollar sort of overshadowing those Middle Eastern tensions. We've seen those crude prices falling from over 3-year highs. I know that we've spoken to you time and time again about the fact that these oil prices are much higher than your current forecasts. What do you expect from here? Do you think there is some upside risk perhaps to your current forecasts, which are around the mid-60 level?
Yes, absolutely risk to the upside. I do believe that geopolitics, geotension is driving prices to where they are today, adding insult to injury. We have Iran and Venezuela. Then May 20th, we have a election in Venezuela that could really impact some of the supply picture coming from that country. So, yeah, absolutely. But to be fair, the demand has far exceeded what I could ever imagine for this, early going in 2018. I just was very surprised that 2017 we saw as much as we did, and to repeat that has been stunning, actually. So, am I worried about my position? Of course I am. But I still maintain that we'll see the low 60s by the end of the year. It may not be for good reason, but I do believe that situation in Libya, Iran, Venezuela are really driving this market currently.
Yeah, and look, it's obviously a supply issue at this point. You speak about the falling production and the output in Venezuela over and above the Middle Eastern tensions. I think Iran pumps about 4% of the world's oil. So obviously with those US sanctions, that could be set to cut off some of that supply. And as we mentioned in the lead up to you, I think the key question is whether some of those other major crude producers will ramp up the output to fill in the gaps of the Iranian exports. What do you think will happen if we do see those sanctions imposed and that 4% of the world's oil coming out of the market?
Well, it'd be easy to say that people can just flip switches and make up that supply. Obviously, it's not that easy. There's a lot of time in between. It costs money. So sadly, oil could, $75, $80 a barrel wouldn't be out of the question, given it's gone from 60 to 70 on just a lot of tension. So it could. The supply story, yeah, we could add supply, but it would just take some time. There's going to be some lag. So just keep an eye on the forward curves that are suggesting a leveling off. But right now, we're in a pretty scary situation.
Yeah, absolutely. Now today, look, it was all about inflationary pressures. We've seen that US dollar rising, and that's put that upward pressure on Treasury yields through the session. Let's just talk a little bit more about the dollar, because that obviously feeds into commodities. The strength of the dollar putting pressure on crude prices and gold. I know gold is sitting at its lowest level of 2018 as well, with the rising US dollar.
Yes.
Do you think the uptrend here is justified, and do you think we can expect to see more strength in the dollar off the back of, recent data which seems to be showing health in the economy?
Yeah, the U.S. dollar, the move is justified, and I've been in this business for a long time, and I'm continually blindsided with how strong momentum can be. We just can't underestimate the short covering that's going on in the U.S. dollar right now, and has been, and that's causing this whole lack of common sense, as it were, the breakdown in correlations that we've saw in the dollar for so long. But now we're just seeing a massive amount of short covering. Going forward, can the dollar go higher? Yeah, absolutely. But I don't believe in U.S. exceptionalism when it comes to data. I think there's better places to invest your money right now. And I think interest rate differentials will come back down. All that to say, I can see the dollar index back down at 80 and be quite happy with that without impacting too much of anything else. I mean, I do believe these moves tend to overrun themselves one way and the other. But I do think we're, at some point at the start of another dollar bear market, but it won't happen anytime soon.
We speak there about the Treasury market today and consumer spending sort of picking up. I think the debate has now shifted, and you point to this in your note, that the debate has shifted from whether or not there's adequate appetite for new Treasury supply to whether or not the economy can actually sustain high interest rates. It certainly seems like markets are quite apprehensive, though, about this resurgence of growth and inflation in the economy. What did you make of that retail sales print? Was it enough to justify that concern in the market today?
Yeah, great question. I don't think so. It is true that retail sales was in line, but what was better was that February and March were both revised upward, and upward by a lot. So that really did give a boost. But I think going back, I mean, does it justify 10-year yields going up 7 basis points? I don't think so. But when you look at corporate issuance, sovereign supply, I think that drove the market to where it is, and it tripped off a lot of shorts at that 3% level. And here we are at 308, whatever it happens to be. I don't think it's economics per se. It is true that some of these numbers have gotten a little bit better, have stopped stalling out. But on the other hand, the differentials have just gotten too wide between other countries, and I think that's why we're seeing the levels we're seeing today.
So with these inflationary pressures rising and that yield sort of moving up, and with the backdrop, of course, of higher interest rates, where to for equities from here? Do you still remain constructive on the outlook for the equity market?
I do, and I still remain a lot more constructive about the Eurozone, especially being overweight in the financials, even cyclicals. I will be the first one to say that's a very stretched trade, like cyclicals versus defensives. But, you know, within that space, I like the industrials. The U.S., I continue to be neutral. I continue to be overweight in Japan and in the Eurozone. I still think with the Eurozone, it's a great story, a few years behind the U.S. in the economic story, or the recovery, as it were. So I do believe that's the place, better bang for your buck, as it were.
All right, fantastic, Larry. Appreciate you joining us and taking us across all those major market moves today. Thank you so much.
Thank you.